In this week recap, the earnings recession is over. Uncertainty on yields persists even if the Fed doesn't raise rates anymore. Deflation is the last thing China needs. Forex overview. Weekly asset performances. U.S. stocks extended their November rally, led by tech giants. A rebound in the most influential S&P 500 group pushed the benchmark to a 7-week high. Microsoft reached an all-time high, and Nvidia extended its advance for 8 consecutive sessions. Solid earnings and a drop in long-term yields supported sentiment. Stocks followed the bond market volatility since March. Overall, market swings indicate investors remain deeply confused about how the most aggressive interest rate cycle in the last 4 decades will impact earnings, the economy, and corporate valuations. Yet, all this anguish is masked by the seemingly unstoppable advance of market cap-weighted indices. While the S&P 500 gained over 1% for the week, an equal weight version, effectively increasing the influence of non-megacap stocks, decreased. Meanwhile, small-cap Russell 2000 companies recorded their biggest drop since September. The Nasdaq is now at its most expensive level ever compared to small caps. Global stocks saw inflows of $8.8 billion in the week ending November 8, according to EPFR Global data. However, liquidity remains the preferred asset class for investors, with about $77.7 billion flowing into money market funds during the week. Treasury bonds had mixed performance, with a weak auction of 30-year bonds and Fed Chair Powell's assurance that the Fed won't hesitate to raise rates further if inflation justifies it. Long-term bonds outperformed, and yields on the rest of the curve increased. Traders continued to watch the latest statements from U.S. officials. Atlanta Fed President Raphael Bostic stated that policymakers can bring inflation back to their target without the need for further rate hikes. His San Francisco counterpart, Mary Daly, mentioned that the central bank might need to intervene again if inflation progress stalls. Friday's data showed that consumers' long-term inflation expectations reached a 12-year high, while economic concerns weighed on sentiment. Bitcoin rose to 18-month highs on hopes for the approval of a spot ETF. The dollar recovered some losses from the previous week. Gold fell for the second consecutive week, dropping by 3%. Oil recorded its third consecutive weekly decline due to growing concerns about global demand and the easing of the Israel-Hamas war risk premium. The earnings recession is over after 3 consecutive quarters of year-on-year declines. U.S. corporate earnings grew in the third quarter. As the chart below shows, Wall Street is confident that their growth will continue. Consensus estimates indicate that analysts believe the earnings recession is over. The corporate sector is not the economy. But the two are closely linked. How is it possible that gross domestic product, GDP, has grown while corporate profits entered a recession and are now recovering? Unlike GDP, S&P 500 profits are more oriented towards goods rather than services. A recovery in goods activity should support future earnings. But this will clearly depend on the health of consumer spending. Another explanation is that companies quickly cut their costs and are now enjoying margin expansion. Corporate profits still seem relatively weak given the state of the economy. Earnings have lagged behind GDP growth for the 5th consecutive quarter. Historically, they have outpaced GDP by an average of 1.5 percentage points since 1950. This is largely due to the shift in buying habits after the pandemic, with consumers moving from goods to services. If there's one thing the third quarter earnings season has told us, it's that CEOs are concerned about the effect of higher financing costs on profits. But currently, especially after the enthusiasm for the likely peak in rates, the belief is that companies can still earn despite the increased interest burden. An economic recession could change things. But at present, the corporate world tends to contradict the view that the economy is slowing rapidly. The only downside is that expectations for both sales and earnings have been drastically reduced for the current quarter. But this data should not be given too much weight, as about half of the decline is due to idiosyncratic issues of 2 pharmaceutical companies, Pfizer and Merck. Uncertainty on yields persists even if the Fed doesn't raise rates anymore. The bond market has been in chaos since the Fed began raising rates to combat inflation. Now that the central bank may be done, the logic is simple: yields could be pushed down. The market believes that the peak in interest rates has finally been reached, and cuts could come as early as next year. But for those hoping for lower yield volatility, it's better not to jump to conclusions. There are many other plausible scenarios for the trajectory of interest rates. Whatever the ultimate outcome, it will be crucial for the well-being of households, businesses, and investors. Market expectations for rates have been driven by recent data and some Fed communications. A series of economic indicators suggest an increasing likelihood of a soft landing, with a gradual cooling of activity and further decline in inflation. Yields sharply dropped in response to signals that the Fed might be done. Their movement was accompanied by a substantial drop in oil prices and a stock market rally. Although these developments are positive, there's an important caveat. The path from here may not be as straightforward as the consensus suggests, especially in predicting rate cuts alongside consistently lower inflation and robust economic growth. It is certainly possible that a soft landing in the United States allows the Fed to begin rate cuts early next year. However, there are other equally plausible outcomes with a higher cumulative probability. What is clear is that the Fed's policy itself will have a less deterministic impact on yields, especially compared to 2022 and 2023, unless the central bank makes another policy mistake. Government bond issuance and economic developments will increasingly matter in 2024. In such a paradigm shift, rates could decrease because the economy slows more than currently anticipated due to the delayed effects of monetary policy. At the same time, downward pressure on yields from disinflation could be countered by the government's need to attract buyers to the substantially larger volume of bond issuances needed to fund the fiscal deficit. It's also possible that the economy may continue to prove strong enough to withstand headwinds. In this scenario, pressures on core inflation could persist longer than initially expected. In summary, there are reasons why official rates could decrease in 2024 and reasons why they could remain high. Deflation is the last thing China needs, no matter how good the growth numbers are. Chinese consumer prices have experienced further decline, suggesting a significant recovery is still distant. The CPI fell by 0.2% compared to the previous year, while producer prices dropped by 2.6%. Despite all the positive short-term news, the price decline indicates anemic demand levels. The economy expanded faster than expected last quarter, and several investment banks revised their forecasts upward. The International Monetary Fund was optimistic. According to this week's data, imports are growing, and car sales are increasing. Considering the surge in inflation in most major economies last year, one might think that deflation is a blessing for China. In reality, a prolonged price decline tends to create the expectation that if businesses or consumers wait a bit longer to make a major purchase, things will be even less expensive. This behavior can be highly destructive for an economy. In response to deflation, the Chinese central bank can cut interest rates, as it has already done. Another 10 basis point cut is expected next week. Fiscal policy also plays a significant role. Beijing has shown a greater sense of urgency. Last month, Parliament gave the green light to surpassing the traditional 3% of GDP deficit limit. Inflation data reminds us how far China has to go before its economy can resume functioning at a growth pace more similar to that of other major powers. They also partly explain why investor sentiment is so weak. Chinese stocks are among the worst global performers this year. Historically low valuations have done little to support the benchmark. The CSI 300 index is trading at 10.5 times future earnings, below its 5-year average of 12.4.